Hi everyone, Larry Bailey here, bringing you another market update. Today is September 16th. We are going to be going through the week of September 9th in review. Lots of news coming out this week, especially with regards to the Federal Reserve and deciding what happens to the key interest rate based upon all the indicators they have discovered. We're going to go through the last stories from last week that are the most prominent. The first one is more progress is made on consumer inflation. We'll talk about annual wholesale inflation falling below the key levels. The next story we'll talk about is housing remains, as always, a great opportunity for wealth creation, depending on how long you want to hold on to that real estate. And the last story is continuing jobless claims tops 1.8 million for the 14th straight week. So when we get into these stories, thank you very much to everybody listening on podcast. If you want to actually check out what's going on full video, head over to Mastering Encompass or over to the Mortgage.community. You'll always find great information as well as all of the replays at each of those places. Let's get into this week's stories. First story is more progress on consumer inflation. So when we get into this idea of consumer inflation, we think about the Consumer Price Index, that's the CPI. And when we look at what's going on with the CPI, really over the last year, it's been a very steady and obvious decline, although obviously not as fast as everybody would want it. So the latest CPI showed that more progress on headline inflation as consumer prices rose 2.5% for the 12 months ending in August. This marked a slowing from July's 2.9 annual gain and the lowest reading since February of 2021. This is a pretty big deal. This core measure, which strips out the volatile food and energy prices, that increased 0.3% from July, coming in just above estimates. The annual reading, that held steady at 3.2%. It's important to note that the shelter and motor vehicle insurance costs were the key reasons for pricing pressures that we've seen last month. Because together they made up 89%. That's 9 cents out of 10 cents of that inflation in August came from shelter, so housing price increases, and motor vehicle insurance costs. Many other major items such as energy and new and used cars actually saw prices flat to lower in August. This suggests that most of the inflation has been quelled except for a few key areas that are keeping it artificially high. Going back again, shelter, which I understand, but motor vehicle insurance. Who would have thought that? That's why these stories are really important to understand the details of what's going on. So the bottom line with the story, gang, is cooler consumer inflation and rising unemployment have caused the Fed to acknowledge, finally, that they need to begin to cutting their benchmark Fed funds rate, which, as a reminder, is the overnight rate of borrowing between banks and the Federal Reserve. The Fed's next meeting and monetary policy decision are coming this Wednesday, September 18th, so it's just in 2 days. The only question remains is, what will members vote for? 25 basis point cut? 50 basis point cut? Something different? We'll have to wait and find out. As a reminder, a basis point is 1% of 1%. So 25 basis points is 0.25% interest rate. And how much will that actually trickle down to us as consumers? We'll have to wait and see. Naturally, this affects prime interest rates. So if you have anything that's based on prime, we're going to see that drop based upon the Federal Reserve's guidance. And then also, if you're looking at mortgage interest rates have actually been getting better for the last 2 weeks based upon this expectation. So if there's a change in the decision, we could see some volatility in that. If you have credit cards, yeah, we'll have to wait and see what happens there. I personally seriously doubt credit card rates are going to change much. It's just one of those things. Like it blows me away when I see credit card interest rates with a 3 at the beginning of that interest rate. And it's not 3%, it's 30 something percent. On to the next story here. Annual wholesale inflation falls below key level. So now we're getting into wholesale, right? And wholesale is all about the producers, also known as the Producer Price Index, because that measures inflation on the wholesale level. That rose 0.2% in August, with the annual reading falling from a downwardly revised 2.1% to 1.7%. This core PPI, which strips out the volatile food and energy prices, rose 0.3% for the month, and year-over-year reading ticked higher from 2.3 to 2.4%. So, bottom line with this one is, while the hotter than expected monthly readings did cause the bond market to react negatively when the data was released last Thursday, producer inflation remains tame. August's 1.7% year-over-year reading is well below the peak of 11.7% seen in 2022 and keeps the Fed on track to begin cutting rates this week. Again, we will see what happens. All right, gang, we're going to get back to this story that we've been talking about really since, 2008 probably. But this goes into more information about what's going on with home price appreciation. CoreLogic's home price index showed that home prices nationwide were essentially flat in July after strong growth seen from March through June. Prices were also 4.3% higher when compared to July of last year. CoreLogic forecasts that the home prices will rise 0.2% in August and 2.2% in the year going forward, though remember, their forecasts tend to be conservative. Bottom line here is, while home price gains have been slowing, they are expected to continue. The latest Fannie Mae and Pulsenomics home price expectation survey, I have no idea what that is. Whatever that is, I have no idea. Survey of over 100 top housing experts in the country showed that respondents' average expected appreciation over the next 5 years to be about 20% cumulatively. To quantify this, to put this in numbers, if you bought a $500,000 house and we saw a 20% appreciation over the next 5 years, you'd gain $100,000 in appreciation alone. This survey and appreciation data shows that housing remains a great investment for wealth creation. I'm going to caveat this for a couple things. First of all, remember that if you're talking about your primary home, you got to live somewhere. So yes, you should buy something if you can afford it and it makes sense. I can tell you, I've bought homes to live in and I made a complete error in judgment and I lost money. Even though homes around me were gaining money, I bought and sold the home too quick. And because of the closing costs involved and just the timing of the market, I lost money. So it's not a guarantee. Second of all, if you're talking about second homes and you're thinking about using that second home as a way to gain value in your real estate portfolio, also known as your overall wealth creation, sure, that may work. But again, it's a second home, so that means you're subject to what other people are willing to pay for their second homes, presuming it's in a resort community. And last but not least, your investment properties. Investment properties have two methods of gaining value. Number one is through the actual value of the real estate. Number two is the actual value of the rents. So like anything else, when you have something that's generating income, the value of that asset, if based upon the generation of that income, then you have to keep an eye on the generation of that income, because like we saw what happened with a lot of short-term rentals over the last couple of years in certain markets, those values have actually dropped because the income from the short-term rental market has dropped, and that leads into the value of the home. So be very, very careful. If you're looking for more information about your personal credit or your information, you're just looking for some really good guidance, personal guidance, reach out to me. You can reach out, head over to creditplushq.com. It's a brand new service we'll be talking more about in the month of October and bringing you more information about that. Let's keep going here. Continuing jobless claims top 1.8 million for the 14th straight week. Initial jobless claims were little change in the latest week, plus 2,000, with 230,000 people filing for unemployment benefits for the first time. Continuing claims also saw a slight increase of 5,000, as 1.85 million people are still receiving benefits after filing their initial claim. That's a lot of people. Bottom line here is the measured week for initial jobless claims included Labor Day. Remember that. And this could have impacted the data as people putting off filing if they're traveling or busy for the holiday. If you've never filed for unemployment, you might not realize this, but you actually have to file, and a lot of these filing systems now are IP address specific. So they're expecting you to file your benefits from your home location, or at least your general area. So if you're traveling, you can't file while you're traveling, and you might miss the deadline for cutoff. It's really complicated if you've never been on unemployment. It's tricky when real life gets involved. So we'll see what happens with next week's numbers. So notably, the continuing claims have now topped 1.8 million since the start of June, remaining near some of the highest levels we've seen in recent years. And this data continues to suggest that people are collecting benefits for longer periods of time as new job opportunities become harder to find. And this gets back into the Fed's dual mandate, right? We need to see maximum employment and price stability. So we got both now. We got price stability, kind of seeming like we got under wraps, but now we got to get back to maximum employment. So there's a family hack of the week here. So if as fall's here, you've got soup season. We're back to this again, and there's a good minestrone soup from the Food Housing Network. You can check out this recipe by heading over to Mortgage.community and looking for the replay. You'll see all the notes in there for the family hack of the week. Again, here's what we're looking for this week. You know it. It's Fed. It's all about the Fed this week. So the Fed's two-day meeting begins Tuesday. That's tomorrow, with their monetary policy statement and press conference, which everybody in the entire world, legit, everyone in the world, is going to be watching this, and that's Wednesday afternoon. The Fed is expected to cut its benchmark Fed funds rate. The question is whether it's 25 or 50 basis points or something different. We'll have to see. We also have a full week of housing news with the National Association of Home Builders, also known as NAHB. That confidence rating is coming out for the month, and that's being reported tomorrow and Tuesday. August housing starts will be released Wednesday and existing home sales Thursday. Tuesday also brings retail sales for August, while the latest jobless claims will be reported as usual on Thursday. So when we talk about the markets, what's going on in the markets, the cost of money is really important. We still see that the 30-year mortgage-backed security is around 101.52, so that's fairly flat from what we've seen. It's still trending better. And we also see the 10-year Treasury is 3.655. Which is a dream compared to where that was not only just a few months ago. So we'll see where this goes this week, all about the Federal Reserve. My name's Larry Bailey. Thank you very much for always watching this, and head over to masteringcompass.com if you want to learn more about how to be the best Encompass admin that you ever can be, or head over to mortgage.community if you just want to stay in touch with what's happening in the mortgage industry. And if you're a consumer or you know a consumer who wants to actually understand what the heck is going on and how to best prepare, head over to creditplanhq.com and find out more information there. You guys have a great rest of your day. Take care. Bye-bye.